unfortunately, yeah, no kidding. Our standards tell us if it's not documented, it doesn't exist. So good advice to document. Now, human nature is to procrastinate, and that truly was one of the mistakes we saw in that first quarter of implementation. There's another saying that to procrastinate, it can actually take an art form, and I don't think we use the art form. I think we just procrastinated. The length of my statements will not double. Big mistake. I remember 15 to 20 page financial statements. I think I'm reading 30 to 40 page financial statements. I'm not sure it's increased the meaningfulness of those statements, but they're sure a lot longer to read. This means financial statements will be at last consistent. After all, we're going into the world stage. But it's principles based, and we've got a lot of choices out there, and there's no way these financial statements are consistent company to company. As an example, in the mining industry, you have your choice, like you did in Canadian GAAP, to either expense your exploration costs or to capitalize, and that can lead to massively different financial statements. Balance sheet, income statement, statement of financial position will be very different. And number 10, auditors ask too many questions. There was a lot to consider, and hey, you know what? We're pretty curious guys. Okay, so now I'm going to step into some of the more detailed information here. I talked earlier that we basically got a little bit of a suite: IFRS 10, 11, and 12. IFRS 10 is consolidations. IFRS 11, joint arrangements. IFRS 12 is going to be disclosures, and I'll pass the disclosures on to Erez. And then IFRS 13, which we'll deal with I guess as quickly as we can. So IFRS 10, new concept here. Control is required to consolidate. I'm not going to say that's a new concept, but what we define as control is what is new. They have guidance on the application of the principles of control and guidance on the preparation of the statements themselves. Control, you have it if the investee has all of the following: power over the investee, exposure or rights to variable returns, and an ability to affect the returns to the investee. Now, it's important to state that the physical consolidation, the mechanics of consolidation, has not changed. This is just a definition, and in fact a bringing together of a number of other IFRSs or guidance into one section, so it's all combined in one. Power. The investor has existing rights that give it the ability to direct the activities that significantly affect the investee's returns. And those are referred to as relevant activities. The rights don't have to be exercised here. You just have to have the ability to exercise. And when I say ability, it has to be current. You have to be able to do it today. Application of principles of control. The purpose and design of an investee is something that you would look at. Majority of voting rights. If you've got greater than 50% shareholdings, it's a pretty high probability that you're sitting with control. That's the first thing to look at. So, and I think that was pretty consistent with the old rules. What are the relevant activities and how are decisions about those activities made? Things like capital decisions, budgeting, personnel decisions. So we're going to look for really what happens out there as opposed to what some of the ownership interests might be. They're indicators. It's really a question of control over choices. I remember a great saying out there that you can have any color you want as long as it's black. That would be telling you somebody has control over a situation. Nice to have the choices, but you can't take them. Rights give the current ability to direct relevant activities. Again, that power concept. Exposure to variable returns, dividends, remuneration. operation, use of assets. Who gets to use the ground? Who gets to use the buildings, the office space, whatever it might be? It's the exercise of the power now that you can use. Ability to use power to affect returns. Now, principal or agent, you've got to determine out here whether you are ultimately have control yourself or whether you're acting on someone else's behalf who actually has control. So we have to look at that as well. So an agent or principal relationship. And there's a continuous assessment. So it's not as though, gee, you have power this year, therefore I'll have power next year. You might not. And it's something that you continually have to assess. On an overall basis, IFRS 10 replaces IAS 27, Consolidated and Separate Financial Statements, and SIC 12, Consolidation, Special Purpose Entities. Special Purpose Entities, it kind of reminds me of the Enron days, where we got ourselves into a lot of trouble from the accounting world and financial world. This particular IFRS is trying to draw all those standards into one common place. So it changes the definition of control so that the same criteria apply to all entities. And lastly, power and variable returns indicate control being present. If you have power, you are going to be consolidating. Next is IFRS 11, and that is joint arrangements. Joint arrangements may have a little bit more meat to it. It's an arrangement in which two or more parties have joint control. Term being joint control. If it's single control, guess what? You're back in IFRS 10 and you are consolidating. Parties are bound by a contractual arrangement, so documentation, stuff we love as auditors, is back at you again. And the contractual arrangement gives two or more of those parties joint control over the arrangement. So that's what you're going to be looking for. A party to a joint venture agreement must determine the type of joint arrangement by assessing its rights and obligations. So we're going to go to those documents, go to those contracts, read through all that stuff, and determine if you have one of two type of joint arrangement. And it's either going to be a joint venture, which is going to have some pretty specific rules, or it's going to be a joint operation. And let's look firstly at joint venture and figure out what that is. It requires unanimous consent for decisions about relevant activities. Unanimous consent. No one really has control. If it's three people in a joint venture, chances are three people are going to have to sign. And it's really about a little bit of, what are we going to call it, compromise, because no one's really going to get their way. It's got to be a mutual decision. So that's critical. It's not to be confused with another joint venture that we use in the mining industry, a JV, typical property agreement. I consider that to be a homonym, and a homonym, I believe, if we looked it up, is a word that sounds the same, but has two different meanings. Parties have rights to the net assets of the arrangement, the joint venturers. So that means that the JV is the one who owns the assets and is responsible for those liabilities within the joint venture itself. They're not yours, they're the JV's. You just own a piece of it. The loss is limited to the investment itself. So that's JV. After JV, we can only have left a joint operation, or a home JO. And the parties themselves, the parties, the companies, the participants have the rights to the assets and obligations and liabilities relating to the arrangement. That's a joint, those are the joint operators. They share ownership in the assets and liabilities and expenses in a specified proportion and are liable for claims to third parties. So no longer is there an entity out here, we talk JV, it's a standalone, it owns that stuff. I'm talking about now, me as a company, I own pieces of something, as do other participants in that arrangement. When looking at whether you have a joint venture or a joint operation, first things to consider, gee, in the first place, do I have control or does someone else have control? Because it'll pop you back to IFRS 10, consolidation, someone else might have it. look to the structure, is there a separate entity? That's a huge question, because guess what? If there isn't one, it's not going to be a JV. It has to be that entity that owns those assets and liabilities and the loan by itself. So you're going to look for legal form. Terms are agreed in the contract. The purpose, the term, the appointment of the board, the capital contributions kind of defines how much everybody's going to have to put in. And you look to other facts and other circumstances. That is me on a bad hair day. That's actually last Halloween. It's not a pretty picture. What can I say? But it is Halloween. I thought I'd throw it in there. A short and true story. When I was born, the doctor came over to my mother and said, "Mrs. Thomas, I sure hope your son is smart, because she sure isn't much to look at." Still true today. Oh, come on. Okay, so just a little flow chart here of joint arrangements. You're either going to have a separate vehicle, in which case it's going to point you into the, I guess, the right-hand side of this. If there isn't a vehicle, you're automatically in a joint operation. If you do have a separate vehicle, you still have some assessments to make. And we've talked about those. The legal form of the vehicle, the terms of the contractual arrangement, and relevant other facts. So you're then either going to have a joint venture, or you're going to push yourself into being a joint operation. And again, consistent JV, you have mutual consent by everybody. No one is a decision maker. All are the decision makers. Financial statement effect of IFRS 11. The JV is to be accounted for by the equity method. In the equity method only, previously, we were allowed to elect to proportionately consolidate, and that has been taken away. And that's pretty critical, and that may change a few companies out there for their accounting. A joint operation means the operator will recognize its own assets and share of jointly held assets, its own liabilities, and those jointly held liabilities, and so on, including its share of expenses. Joint operator who is responsible for an obligation would recognize 100% of that obligation. And if one of the other parties to the arrangement owes them for reimbursement, then they would end up with effectively a receivable, and that receivable does not get offset. It's subject to separate impairment testing. So this is kind of reminds me of an operator of a mineral property, where you're going out and doing the work, you're loading up the property with contracts. You're going to book 100% of those costs. Against that, you're going to make cash calls and record those as receivables from the other parties to that arrangement. So pretty standard stuff, but remember that the receivable is subject to impairment testing. So if you're going to say, I'm making a cash call, us poor auditors have to ask the next question, can they afford to pay? Is that receivable valid? So you could end up with a big liability and not very much of a receivable. It's possible. Joint operation requires recognition of assets, liabilities, and operations according to an entity's share of these items as determined by the contractual arrangement, not just the ownership interest. So it's looking to the contracts. We talked about earlier, it has to be a legal form, it has to be documented, and that's what we will be looking to, is that documentation. Overall, it seems that IFRS right now are trying to consolidate, take sections of its own handbook and mesh them into one section. IFRS 11 supersedes IAS 31 JVs and SIC 13 jointly controlled entities, non-monetary contributions by ventures. There are only two types of arrangements. You're going to either have a joint venture, or you're going to have a joint operation. Joint venture participants must the equity method, no longer proportionally consolidate, and a joint operation participant will still follow basically similar to joint assets and joint operations used currently, so we don't expect there's a whole lot of change there. But you are going to have to look through the contracts and make sure you adequately have defined what kind of joint arrangement you have. And I think at this point I've got to sit down, take a little bit of a break, and Erez will take you through with IFRS 12.
Quite interesting, I thought, as I was listening to 10, 11. Maybe, if you don't mind, maybe I'll just kind of bug you for a question or two, just so I'm clear, in case some people have a similar thought pattern to me. A lot of companies enter into mining agreement, and we acquire 100% of mineral claims in such and such region of British Columbia. And sometimes, after a year or two of work, we option out 30 or 40% to a third party who's going to come in and spend money on the ground, issue us some shares, make us some cash payments. So in that instance, when somebody's about to earn a portion of our property, is it right to say that you still just call that a mineral property? Does that sound about right?
Or E&E asset?
Or E&E asset?
You could end up in a position where if you've reduced, let's say it was in a company,
Yeah.
because I think that's the situation you might be referring to. If it's within a company, you could actually bring yourself down to being an equity, a one-liner on the balance sheet, as opposed to calling it mineral property on the balance sheet. In all likelihood, you would call that equity investment, and that's the question.
That's the question.
Having said that, one would expect that the disclosure for that equity investment would expand. Can everybody hear me back there? Okay. I think or if they can't put up their hands because they can't hear me anyway. I would expect that the note would pretty much carry over the same information that you previously had as being a mineral property. In other words, this equity investment consists of a mineral property, and highlight really what it is that is your main component of your equity investment. That's my expectation.
So it's quite interesting because there's a fine line between what's just a mineral property now, what's a joint venture, or what's a joint operation. There's quite a distinction. This guy mentioned a lot of it's going to boil down to what the contract says, and that's something that there's a few lawyers in the room here, right? But in the term joint venture is used quite loosely. Right? Like we always use that. Oh, it's a joint venture, but now that we've got IFRS 10 and 11 clearly defining what a joint venture means versus joint arrangement versus joint operation, there's going to be quite a few cases out there that are going to require some analysis, right? Because if you're doing equity accounting rather than just your typical mineral property capitalization, then it makes quite a bit of a difference, because now if you're doing equity accounting, you're taking your pro rata share of losses or earnings of that entity, right? And the only last one I had was, so if it's a true joint operation, and I think Guy mentioned that you would take a proportionate share of assets and liabilities. Is that similar to saying proportionate consolidation?
It's very similar. You've got your own assets to begin with, but then as a structure, you can have other jointly held items. And so you've got I think the answer is yes. Proportionate consolidation is still alive, but slightly altered.
So it's quite interesting, because there will be some cases where it's a true joint operation, and other than equity account, you might just pick up your share of the assets and liabilities. But of course, the concept of proportionate consolidation that used to be that you would just cut through, right? The percentages. If you own half of it, you would just take your balance sheet, divide it by half, and add it to yours. Whereas these new standards are specifically targeting your proportionate share of the assets and liabilities. So it's quite relevant for a lot of the crowd here that are involved in the resource sector that have mining agreements and that option out mining of properties to various vendors and so on. So, and again, these standards are coming January 1st, 2013. So it is possible that it might not affect you this year, but when you do your Q1 for 2013, it is possible that you'll have some of these arrangements that are not just a mineral property anymore, they're now equity accounting or maybe proportionate. So be conscious of that. Just awareness is really what we really want to get out of these two pronouncements. So in terms of the disclosure, again, it's effective January 1st, 2013. You can adopt early. You can adopt early for all the accounting fans out there. You might want to, right? If you do have one of these arrangements that will change, okay, next year, and you know that now, you could put that through your December 2012 statements in order to kind of avoid the Q1 and Q2 and Q3 having to go back. So something to think about. Again, significant judgments, right, and assumptions in determining how to account for the under entity. So again, judgments means why did you think it's a real joint venture or a real joint operation? What are the determinants that you made? For example, the legal contract says unanimous consent or some of the other factors that I mentioned. So you do have to disclose how you came up with the rationale. So now specific disclosures on the types of arrangements that we have. So Guy went through consolidation, and the definition of what control really means has expanded. As you mentioned, control's always been there, but now it's a little bit more defined. So if you have a subsidiary where you're controlling it, then the information that you must disclose is the percentage you own. I think everybody's doing that. The year end, only if it's different than the parent company. Other than that, you don't need to say that. Let's assume that it is. Restrictions or ability to access, use assets and liabilities. It's rare, it's seldom when you have a true subsidiary that you have a restriction to access their assets and liabilities, but it can happen. If it does, you need to say what those are. The name of the subsidiary, everybody's doing that. The place of business, where it is, and what it's doing, and then the voting rights. So if you look at this by and large, the description of your subsidiaries that you've got now in your financial statements suffice. We tend to make sure that we say the name, how much you own, what it does, and whether or not it has any restrictions. If there's nothing else that fits, you don't need to say that there are no restrictions on the subsidiary, only if you do. So if you've got an interest in joint arrangements and associates, similar stuff with one big difference. So the name, the nature of the relationship, the place of business, the percent that you own of it, the method of accounting, whether it's equity or fair value. If you recall under IFRS, you can choose fair value accounting for your exploration assets, for your mining assets, for PP&E. We'll get into a little bit of kind of market observations, but by and large, I would say almost every company that we have seen has not elected to use the fair value method for E&E assets. Most of those reasons are clear. Do a fair value analysis of all the mining, exploration, or development properties is not possible or not practical, and so by and large, it's at cost still. However, you can do a fair value. And the last one, which is probably the most significant one, is summarize financial information about the JV or associates and the restrictions. So if you are doing equity accounting, okay, for financial statements, you are required to provide some summarized financial information about that JV. So that's the one thing to watch out for. If you have some of these cases that are going from mineral property to a joint venture, there are some additional items to disclose. Without getting into too much detail, that's just what to watch out for. And then there's this third, fourth. I mention it because it's there, but very seldomly, and because we rarely see it, I only wrote one line on it. But basically, you have this thing called structure entity, which is this unconsolidated structure entity. You have to have similar disclosure. I won't get into more detail on that because I don't think we've ever seen that actually yet. So that's a little bit about disclosure for IFRS 12. The main stuff is the usual things that you've seen before under IFRS. Where is it doing business? What it's doing? How much of it do you own? If it is a JV, you have to disclose some financial information about the joint venture itself. And now I'm going to, I think, switch it back to Guy and fair value measurements.
Talked earlier about IFRS as kind of trying to consolidate some of the concepts, and here we are again in another juncture where we're trying to set out a single framework for measuring fair value. And we're pretty knowledgeable about fair value in terms of financial instruments, and this standard
goes beyond just financial instruments. It goes to the non-financial instruments, and it defines fair value. And it requires disclosure about those fair value measurements. And Erez mentioned earlier on that there's more information required about significant judgments and estimates, and this is really part of it. It applies when another IFRS requires or permits fair value measures or disclosures about fair value measures and measurements